Hello friends, we'll be discussing the concept of basic elements of money and banking, or rather the credit creation concept of money and banking here. Now, what exactly credit creation means? This means something which is related to money and banking together. Creation of credit, as the name suggests. Now, meaning, or rather the meaning of this refers to a bank differs from other financial institutions because it can create credit. Who offers you loan? Bank or private lenders, right? So they create the credit here. Banks have the ability to expand their demand deposits as a multiple of their cash reserve. Now, banks have the specific ability of multiplying, or rather creating a cash deposit or increasing their cash deposit as per the multiple reserves or other multipliers of reserves here. Now, this is because of the fact that the demand deposit of the bank serves as a principal medium of exchange, and in this way, the bank manages, or rather, bank manage the payment system of the country. Because of this fact of demand deposit here, bank serves as a principal medium of exchange, and in this way they manage the demand deposits together. Now, in short, expansion of deposits is called credit creation. Whenever you expand the deposit, that is known as credit creation here. And the ability of the bank to expand a deposit makes them unique and distinguished from the other bank and non-banking financial institutions. So because of this specific feature, it is different from non-banking financial institutions, which is also known as NBFI. Now, demand deposits are an important constituent of money supply, and the expansion of demand deposit means expansion of money supply here. Now, demand deposit, or rather demand deposit, speaks about important concept of money supply here, and because of this expansion, we can speak that money expansion is better for the bank, or rather easy process for the bank here. The whole structure of banking is based on credit. Credit means getting the purchasing power, that is money, now by a promise to pay at some time in future. What exactly credit means? Now, credit means is that because of this credit, you get the purchasing power, but the payment can be done at a later stage. For example, you take a phone on loan. So basically, you buy the phone, you don't pay any amount while buying the phone. Usually, what happens if you have to buy this commodity, you have to pay the price first and then you get this commodity. But now, because of all these financial institutions, or rather increasing demand of all these things, increasing variance of all these things, we have, like, we can buy this product right now, we don't have to pay anything, we can pay it later on. That is known as the credit creation here. Now, in other words of Kent, credit may be defined as a right to receive payment of obligation to make a payment on demand or at some time on future on account of an immediate transfer of goods. That means for relation to immediate transfer of goods, all these things, or rather this obligation to pay or at some demand or at some different time in future, can be done, and this is known as credit here basically. Now, in the sense, the word credit, debt and loan are synonymous. If you have to mention word credit, the synonyms of that would be debt or loans. Now, credit or loan is the liability of a debtor and the asset of a bank. If a bank is giving you loan, that is an asset for them and it is a liability for you. If you are depositing, or rather if you are keeping your money in your saving account, that is an asset for you, liability for the bank, vice versa. Now, the creditor believes that the debtor will return the loan and so decides to give the loan. This is how the basic functionality works. Advancing credit or loan essentially depends upon the confidence, that is the first part, character, capacity, capital, collateral of the debtor. So these are 5 C's that you have to discuss about. 5 C's that can actually help in securing a loan. What exactly that is? The first one is confidence, the second one is the character, the third one is the capacity, the fourth one is the capital, and the fifth one is the collateral. These 5 C's can make all the possible necessities go away. So bank credit means bank loans and advances basically. Now, a bank keeps certain proportion of its demand, or rather of its deposit, as a minimum reserve for meeting the demands of the depositor and lends out the remaining excess reserve to the earned income. So basically, if you're running a bank, basically you have like deposits coming in. The basic function of the bank is to accept deposits and to provide loans. Okay. Now, if the bank has received 100 crore rupees, Out of these 100 crores, they will keep certain deposits or rather certain amount of money as a necessity to meet the demands of the daily consumers, daily progressors, or daily people who come into the bank for withdrawals. Maybe like, let's see, we keep 75% of that 75 crores to service thing. Now these 25 additional crores that they have, they can give this as a loan to people and earn interest on them. That's how the bank functions. So the basic money that the bank earns here is via interest, is via charges, all these things, not just because of accepting deposits and providing loans. Hence, the bank loan is not paid directly to the borrower, but it is only credited in his account. Every bank loan creates an equivalent deposit in the bank. Thus, credit creation means expansion of the bank deposit. The word creation refers to the ability of the bank to expand deposits as a multiple of its reserves. So, whatever reserves are there, in multiple terms of that, if the demand deposits or other deposits can be created as a form of loan, that is known as credit creation basically. Now, during the process of credit creation, there arises two important issues which holds utmost consideration, namely first is profitability and liquidity. Now, profitability. Banks are guided by the profit earning motives in its operation. Every bank that functions apart from the non-banking functions, these banks or rather the motive of this bank is to earn profit, which is very normal, very essential. So the loans granted by the bank must be in the manner in which it earns interest higher than what the bank pays on deposit. For example, the loan that you get or rather the personal loan gives you or rather it is at 11%, but the interest that you get in your savings account cannot be more than 6% or may not be more than 7%. So there is a straight margin of either 5% or 4% of earning. Imagine 4% on 25 crores. That's the kind of earning that they have. That's how it works. Now, liquidity. Banks, on the other hand, subsequently should be able to meet its commitment to pay up the cash to the depositors. Again, on the other hand, banks should be able to have liquid funds with them. That means if any depositor comes in and wants to withdraw certain money, bank cannot deny that, okay, we don't have money, we have given it on loan to someone else, we cannot pay it to you right now, even if it is your money. It cannot happen. The bank will completely go down, it will be shut down at any given point of time. Hence, when the depositors decide to exercise its right to demand and cash their deposits, this is when the bank should be able to pay them up. Hence, profitability and liquidity are the two questions and two main important questions to adhere to. Now, the banking crediting or the bank crediting creating process is based on the assumption that during any given time interval, only a fraction of its customer will be in genuine need of cash and that all customers would not turn up for demanding cash against the deposit at one point of time. Again, there is a basic assumption that if 10 people have deposited in your bank at any given point of time, not all those 10 people will come in and ask for withdrawal of the money. That won't happen. That's the assumption that they look into. At any given time, only a fraction of total deposits would be used to pay cash. So whatever total deposits that you have, only a fraction of it will be used to pay up the cash here. Therefore, banks can lend the remaining proportion of money into the market, thereby creating credit here. The net result is that the bank is able to meet the demand for the encashment by its depositor by maintaining cash reserves, which are only a fraction of its deposits or rather deposit liability basically. Now, this phenomenon, or rather this phenomena, is known as a fractional cash reserves or cash deposit ratio, also known as CDR, which is or rather should be less than 1. CDR should always be less than 1 basically. So something that is bigger will be happening or rather greater than 1, but this should be actually less than 1. The experience of the 1920s, 1990s, and 2000s keep renewing economics' interest into the role of credit in macroeconomic fluctuations, as they are of the view that not just money but credit also matters for the macroeconomic and financial stability. Hence, the Great Depression of 1920 is also viewed as a credit boom gone wrong. So, whatever happened in 1920, that is a Great Depression, whereby there was a lot of credit that was given up in the market and it completely went into the loss. Hence, that depression is also learned or rather it's also taken as a learning that it shouldn't be that all the money should be given in terms of the credit outside the market. Now, further, Subprime lending crisis occurring between 2007 and 2010 is also reminded of the basic important things which regulations of lending. So basically, because of these things, because of those great depressions, then came in all the policies, rules and regulations, how much can be lended to people, what is the kind of lending that has to be done, what are the criteria that needs to be met. All these things come into the picture. So you cannot just take loan just because you are eligible for it. You have to go ahead and produce, or rather perform all these things, produce all those documents, all the proofs related to it. It is generally argued that the credit creation may fuel bubbles, make the system unstable, and lead economies into crisis. The world has observed various Minsky moments, and these form interesting case studies for understanding the financial crisis and rules of credit. Again, therefore, central banks all over the world not only set monetary policies to manage control inflation, but they also take care of credit market conditions for the stability of economic system. That's how things work here. So this is all about credit creation, and that marks the end of this specific topic. That's it for the video. Thank you.